Some people think that buying stocks at low prices after they've been beaten down is a sure way to make money in the stock market, but sometimes, depending on the company, right, if they don't have a bright future ahead of them, that strategy could backfire pretty quickly. So I want to talk to you about 3 companies that I think have a bright future. One of those companies has an almost 400% upside, and we're going to talk about that company towards the end of this video, so stick around. Hey guys, welcome back. Thank you so much for joining me for another video. I'm Richard Allen. If you aren't subscribed already, please do so and hit that like button if you find any value or learn anything new in this video. We're going to talk about 3 companies that are really close to, I think, bottoming out. And I think it's important to look at companies that are distressed in times like this when major indices are at all-time highs. You think about, look, why are these companies down so far? Most of them ran up a ton along with a lot of other companies and then crashed in February. One of these companies is down over 60%. A couple of them are down over 40%. So we're going to talk about these 3 companies. The first company we're going to talk about is PaySign Incorporated, and they have a pretty unique business structure that caused them to fall quite a bit during the pandemic. They are a payment processor and payment provider platform, pretty small compared to the others like PaySafe and Square and PayPal and things like that. But they offer a major part of their business is offering prepaid cards for plasma donation centers. And there are quite a few people that have needed to do this sort of thing just to make a little extra money. Some people donate plasma because it provides a service and is a way for people to give back as well and make a little bit of extra money. But PaySign offers these payment cards for some of the largest blood plasma donation centers. The blood business and plasma business took a big hit during the COVID pandemic, mainly due to worries over virus transmission. This business is only just now returning back to normal. So PaySign struggled a lot in terms of revenue and things like that. And that's why their stock year to date is down 48%. So let's take a peek at PaySign, ticker symbol PAYS, and what the analysts think. It's a strong buy. 3 buys, 1 hold with a 64% upside. If we look at the price targets here, we have a 5-star analyst giving this 124% upside. Just reiterated this price target last month. So we have ranges anywhere from $3.50 on the low end to $6 on the high end. And like I said, they're up 14%, almost 15% today as of recording this video. So let me know what you think about PaySign down there. Do you think the plasma and the blood situation is going to get better for PaySign, or is the Delta variant going to screw them over and they're going to fall further? Now, again, this is a penny stock, probably relatively pretty risky. They don't have a ton of revenue. It's a company that is struggling right now, but I think they have a promising future. All right, second company we're going to talk about is Lendingtree, ticker symbol TREE, T-R-E-E. I hope you can spell tree if you're watching my videos. But this company is down around 40% this year. So they've had a tough year, but they have some big price target based on what analysts have to say. Now, their revenue fell quite a bit during the coronavirus pandemic. People were spending less money. They were borrowing less. And Lendingtree's business model essentially is determined based on people spending money and looking for different sort of better rates and things like that. So they have a website where people can go and find the best deals on credit cards, deposit accounts, loans, insurance, and other types of financial products. They still had almost $1 billion worth of revenue in 2020, but revenues were down 20% from 2019. There are signs that the company is turning around, however. Q2 revenues hit $270 million, a year-over-year gain of 46%. EPS for the quarter was 48 cents per share compared to a $2.29 loss reported in the same quarter a year ago. For Lendingtree, you've got revenue recovering, right? That's a big sign that we're going towards a better place for Lendingtree, ticker symbol TREE. Let's take a peek at what the analysts have to say about Lendingtree. This is a strong buy based on 3 recent analyst ratings with an average upside now of 85%. On the low end, price target is $275. On the high end, price target is $350. So there are some people, 5-star analyst James Friedman from Susquehanna, I'm sure that's how you pronounce that. I was about to say Sasquatch, from Sasquatch Financial, 114% upside, and that was made 3 months ago there. Let me know how you guys feel about Lendingtree. Do you think there's some promise? But the third company I want to talk about is probably why you're here. So if you skipped ahead, go back and watch the other two companies. If you didn't skip ahead, nice job. You're pretty awesome. Let's run through. The third company we're going to talk about is Esperion, ticker symbol ESPR. And this has some massive, massive upside. Now, this is in the biopharma space, and they're trying to create lipid management drugs that aren't as invasive as, statin drugs. So they're working on drug treatments for elevated LDL-C, specifically low-density lipoproteins that cause cardiovascular difficulties. So a lot of us probably know someone that are on these types of drugs. As people get older, it's definitely more and more common to be on these types of drugs to regulate your cholesterol. A lot of these medical biopharma type companies, if they weren't working on vaccines, a lot of them didn't fare very well during the coronavirus pandemic because less and less people were going in for routine type stuff. They weren't going out to hospitals as much because a lot of people were scared to get sick from the coronavirus, or hospitals in general were saying, look, we're booked, we're full, stay away, we can't help you, kind of thing. And people were worried about just receiving normal treatment like this kind of thing. So a lot of these companies saw less revenue, right, like Esperion did. But that doesn't mean that people with cholesterol issues, it's not going to go away, right? This type of company is still necessary and needed, and you can see that by these increases, right, of 67 to 30% of revenue and prescriptions. So you can see that Esperion is on the right track. They are up quite a bit today. They're up 3% today. This comes with a strong buy based on 5 analyst ratings. But look at that upside, 433%. Even on the low end, $17 low end price target is still a 42% upside from where they are right now. But look at this. We have a 4-star analyst, 3 4-star analysts here, giving this between a 500 and 850% upside for this stock here. And this stock, really not that long ago, if we look at the charts here, this stock was just a $38 stock last year, and a $36 stock back in February. So there is potentially a lot of room for this to run. Biopharma stocks tend to run pretty quick, but it's down a lot over the past year. So just kind of keep that in mind. Guys, thank you so much for joining me for another video. I appreciate each and every single one of you. If you found any value in this video at all, hit that like button for me and subscribe, and I'll see you in the next one.